Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine IFRS 16, leases. This is my second video. So in this second video, I want to examine the accounting for lease in the book of the leasee. So if you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. So in the first video, I've told you that lease is a contract or part of contract that conveys the right to use the underlying asset for a period of time in exchange for consideration. So in this second video, I want to examine how to account for the lease. So leasing, how to accounting for lease in the books of the leasee. In the books of the leasee. So how to account for lease in the books of the leasee. I want to know that IFRS 16 is not interested in the classification of lease into finance and operating lease in the book of the leasee, unlike the then IAS 17, which categorized lease into finance lease and operating lease. So I'm not interested in that classification here in the book of the leasee. I will talk about the finance and operating lease when we get to the book of the lessor. Though we will examine the low value items and short life items in the book of the leasee. So now we want to talk about initial measurement. Initial measurement. Remember, measurement is the basis used in determining the monetary amount at which an elements are to be recognized. So, for the purpose of lease, initial means first time. So, if you want to measure, if you want to recognize lease in the book of the leasee for the first time, how do you measure the value to recognize? I want to know that in the book of the leasee, we normally measure two things. There are two things that will be recognized in the books of the leasee. Remember, the leasee is owing the lessor. So in that case, in the book of the leasee, a liability will be recognized. So you have lease liability. In the book of the leasee, we have lease liability. Then, remember, we have one important accounting concept, which is substance over form concept, which will find that the financial reality take precedence over the legal form. That is, the financial perspective prevails or supersedes the legal form. Just like lease or hire purchase, the ownership is not that of the leasee, but the leasee will still recognize it as an asset in his book. That is substance over form. Despite, on hire purchase, it is when the final installment is paid that the ownership is transferred to the vendee. So, but despite the fact that the ownership of the asset hasn't been transferred to the vendee, yet the vendee will still recognize the asset in his book as an asset. So the accounting concept that prevails that are in use in lease and hire purchase is substance over form. Substance of the transaction will be recognized. Substance of it will be recorded over its legal form. The legal form says you are not the owner, but the substance of it will be recorded. Since you exercise control, since the control of the assets is in your hands, the control passes to you, you will still record it as an asset, despite the fact that you are not yet the owner. So, in the book of the leasee, on initial measurement, two things will be recorded. Number one, we have the lease liability, and number two, we have right of use asset. Right of use assets. These are the two things you need to recognize on initial measurement or initial recognition. So what do we mean by lease liability? Remember, you as a leasee, you'll be asked to make certain payment to the lessor. So it is possible some payments may be made before the commencement of the lease. before the commencement date. And in the future, some payments may equally be paid. Some instrumental payments will be made to the lessor. So those payments that have not been made before the commencement date, those payments that will be paid in the future, you discount them to their present value. So the present value of the lease payments that are yet to be paid, the present value, lease liability, that is the initial value of the lease liability, is the present value of the lease payments that are yet to be paid. You know, if you want to discount your cash flows, we normally discount the future cash flows, not the sunk cost, not the past cost. We normally discount the future cash flows. It is those future payments that have not been paid, the future lease payment, that you need to discount to get the lease liability. Therefore, the lease liability is the present value of the future lease payment, or the present value of the lease payment that are yet to be paid. The present value of the lease payment that are yet to be paid. Lease payments include lease payment. Lease payments include, these are forms of payments that are usually made on the lease. So the lease payments include, number one, fixed payments. So fixed payments, that is fixed amount the lessee will be asked to make periodically. That is fixed payment. Then we also have option to purchase the asset. That are option. So you may have the payment for the period of the option. So we have option to purchase the asset, to purchase the asset. Remember, I've told you the option period must form part of the lease term where it is certain that the option may be exercised. So option to purchase the asset that are reasonably certain to be exercised, or option to purchase the asset where it is certain that the option will be exercised. So where it is certain that the option will be exercised, that means the option period will form part of the lease term. And if the period of the option form part of the lease term, that means the payment for the period of the option will form part of the lease payment. So for better understanding, please try to watch the first video on my first video on IFRS 16. Then number 3, we have termination penalty. Termination penalties. So where either the party to the lease or where the lessee will suffer some penalty for breach of the lease term or lease agreement. So the penalty payable by the lessee will form part of the lease payments. Number 4, we may also have the amount payable under the residual value guarantee. Amount payable under the residual value guarantee. So these are the lease payments. So I've told you, when you discount these lease payments, their present value gives you the lease liability. Now we want to examine the second one, which is right of use asset. Number 2, we have right of use asset. Right of use assets. Rights of use asset. I want to know that right of use asset, that is lease asset, is usually recognized at cost. This is initially recognized at cost. This is initially recognized at cost. So to measure the right of use asset, you recognize it at cost. The initial cost comprises, that is, if you want to determine the right of use assets, these are what will constitute the initial cost that will form the right of use asset. That is the cost that will form the right of use asset. Right of use asset. If you want to determine the right of use asset, that is, you sum up the following costs. That is what I mean. Number one is initial measurement of lease liability. Initial measurement of lease liability. Remember, I've told you to initially measure the lease liability. It means the future lease payment that are yet to be made, you discount them. The present value of the future lease payment. So we give you the lease liability. So the value of the lease liability obtained when the cash flows were discounted. That is what I am referring to here. Then we have lease payment made at or before the commencement date. Two, we have lease payment made at the commencement date or before the commencement date. Remember, I've told you the future lease payments are to be discounted to get the initial value of the lease liability. So it means the past cost, those payments that have been made before the commencement of the lease, will not form part of the cash flows that will be discounted to give you the lease liability. Those costs now that have been made or that have been paid before the commencement date of the lease, so you add it less incentives received. So any incentives, let me put less incentives received, that is less lease incentives. So you deduct that. Then if you have the initial direct cost, you add it to it, initial direct cost. Then if you have estimated cost of removing or dismantling the asset, you add it. Estimated cost of removing or dismantling the asset. The sum of all these will give you the initial value of the right of use asset. Now, let's take question as work example. Keep watching. Example. On 1st of January 20X1, Dynamic entered into a 2-year lease for a lorry. The contract contains an option to extend the lease term for a further year. Dynamic believes that it is reasonably certain to exercise this option. Lorries have a useful economic life of 10 years. If you look at the lease term, 2 years, an option is even a year, which is altogether supposed to be 3 years, and the economic life of the asset is 10 years. So it means the lease period is shorter compared with the economic life of the asset. If it were based on the requirement of IAS 17 leases, we will categorize this lease as an operating lease. But I've told you IFRS 16 is not interested in the classification of lease into finance and operating lease. See, in the book of the Lease, we are not interested in that. So, because both finance and operating lease are given the same treatment in the book of the Lease, but when we get to the book of the lessor, so they be separated. So, Dynamic believes that it is reasonably certain to exercise this option. Lorries have a useful economic life of 10 years. Lease payments are $10,000 per year for the initial term and $15,000 per year for the option period. All payments are due at the end of the year. To obtain the lease, Dynamic incurs initial direct costs of $3,000. The interest rate within the lease is not readily determinable. Dynamic incremental rate of borrowing is 5% required. Calculate the initial carrying amount of the lease liability and the right of use asset, and provide the double entries needed to account for these amounts in Dynamic financial records. The source of the question is Kaplan ACCA story test. The name of the entity is Dynamic. So, the lease term, the first thing is the determination of the lease term. You were told on 1st of January 2021, Dynamic entered into a 2-year lease for a lorry. That means we have non-cancelable period, which is the primary period. Non-cancelable period of 2 years. So now, let's see if the period of the option will form part of the lease term. So, you were told the contract contains an option to extend the lease term for a further year, 1 year for the period of the option. But I've told you the period of the option will form part of the lease term where it is reasonably certain that the option will be exercised. Now, you were told Dynamic believes that it is reasonably certain to exercise this option. Since the option will be exercised, period of the option will form part of the lease term. So this is the period of the option. The contract contains an option to extend the lease term for that year. So period of the option is 1 year. So the lease term will be 3 years. Lease term, we have 3 years. Since the lease term is 3 years, if you look at the requirement, you have to calculate the initial carrying amount of the lease liability and the right of use asset. Since the lease term is a period of 3 years, that means the lease payment will comprises the amount paid during the non-cancelable period and amount paid or payable in the cancelable period. So in that case, so you want to calculate the present value, calculation of lease liability, calculation of initial measurement of the lease liability. Remember, I told you that initial measurement of lease liability is the present value of the lease payments that are yet to be made. So we have here, you have the cash flows. Now, on 1st of January 2021, Dynamic entered into a 2-year lease for a lorry. So 2 years lease, that is year 1, 20x1, 20x2, that is the 2 year. The contract contains an option to extend the lease term for a further year. So we also have option period, which is a year. So 20x3. Dynamic believes that it is reasonably certain to exercise this option. We have the period of the option as part of the lease term because it is certain that the option will be exercised. So, lorries have a useful economic life of 10 years, so the useful life of the lorry is not relevant. Lease payments are $10,000 per year for the initial term. $10,000 for the initial term, first year and the second year, 10,000. And $15,000 per year for the option period. For the period covered by the option, we have 15,000. All payments are due at the end of the year. That's to show that the payments are made in arrears. So this is payable in arrears. So if you watch my next video, where the subsequent measurement will be examined, so you will know how to deal with the payments in arrears and payments in advance. So these payments are in arrears. That is why we have that payment used in the year before due. But if it is payable in advance, then that means it will be used in the immediate preceding year. So you will get to know that in my next video. To obtain the lease, dynamic incurs initial direct cost. The initial direct cost of $3,000. Initial direct cost will not be considered when you are calculating the lease liability, the initial value or measurement of lease liability. It will only be considered when measuring the right of use asset. The interest rate within the lease is not readily determinable. Dynamic incremental rate of borrowings is 5%. So we use the incremental rate of borrowings to discount our cash flows. So the cost of capital is 5%. So we have the present value in dollar. So now you can use the compound interest formula raised to power n. So 1 plus r raised to power minus n. So where n is the number of years. For year 1, r is 5%, which is 0.05 plus 1. That will be 1.05 raised to power minus 1. That gives us we have 0.954. 0.9524. For year 2, 1.05 raised to power minus 2. That gives us 0.9070. For year 3, we have 0.8638. The present value, 10,000 times 0.9524. That will be 9524. 10,000 times 0.9070, which is 9070. 15,000 times 0.8638. That gives us 12,957. So when you sum it up, plus 9070 plus 9524, so we have $31,551. This is the initial value of lease liability. So that is the lease liability initial value. You have to calculate the initial carrying amount of the lease liability that has been calculated and the right of use asset. So right of use asset, to calculate the right of use asset, we have the initial measurement of lease liability, initial measurement of lease liability. From our initial calculation, we have 31 551. We now add any lease payment made before the commencement of the lease, or initial direct cost, or cost of removing or dismantling the asset. All payments are due at the end of the year. To obtain the lease, Dynamic incurs initial direct cost of 3,000. So we add initial direct cost of 3,000. The interest rate within the lease is not readily determinable. Dynamic incremental rate of borrowing is 5%. So if you add this, you sum them up, you have 34,551. This is the initial value of right of use asset. Aside the calculation of the initial carrying amount of the lease liability and the right of use asset, you equally have to provide the double entries needed to account for these amounts in Dynamic's financial records. So the double entry, now with the initial value of lease, let me just raise a journal entry. Journal entry. We have the credit side, we have the debit side. Amount is in US dollar. Now, with the initial value of the lease liability, we debit right of use asset, right of use asset, with the initial value of lease liability, which is 31,551. No asset will have a debit balance. If you debit the right of use asset, then you will credit the lease liability. Lease liability. 31,551 being the recognition of initial value of lease liability. Recognition of initial measurement of lease liability. Now, initial direct cost of $3,000 was incurred. No, this will be debited to right of use asset in order to increase it from 31,551 to 34,551. So you debit right of use asset with 3,000, you credit cash with 3,000. Recognition of initial direct cost on initial measurement of the right of use asset. This marked the end of the solution to the question. In my next video, I will examine the subsequent measurement of right of use assets and the lease liability in the financial statement of the lessee. I will equally examine the classification of lease into low value assets and short life assets and how to measure them in the financial statement of the lessee. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ZICA.